Hello, everyone. Welcome to the first video of Chapter 5. There was a previous video that was just sort of a short primer on the calculation that we will cover regarding capital cost allowance. We will start the course material in this video, but please keep that in mind as we discuss through how to calculate our allowance for how much we can deduct from an asset's original cost. So to get started into the slides. So, capital cost allowance. When we consider capital cost allowance, we have to identify what it means to have depreciable property. On depreciable property, you might have expenditures that are on account of income. These are your current expenditures. These occur on ordinary recurring expenses from carrying on a business. Your monthly rent, paying for office supplies, buying salaries and wages for employees. These expenses are time-based and they're very current. What we're covering is a certain usage of a function or expense that happened right now. So for rent, when I pay the monthly rent, the next month I have to pay it again because this has been used up. Expenditures on account of capital usually relate to purchase or improvement of property to improve a business structure. There's not ongoing routine maintenance. What this means is that these are expenditures on items that are long lasting. They're meant to improve property that's going to be around a while. So, on account of income, these expenditures are very short term, they're timely. We're sort of expensing them as we use these items. But this expenditure on a capital item, we gave a bunch of money at once. We bought an asset, and now that asset's going to be used up over time. So these are capital expenditures. The Income Tax Act usually uses the term property and not asset. Asset is sort of the accounting term, I suppose, that you would use for having a piece of machinery, for example. Whereas the Income Tax Act refers to this as property. You may, during these lectures, hear me use property and asset interchangeably. Property is the definition that falls within the Tax Act. From an accounting standpoint, its equivalent would most closely just be asset. So if I'm jumping between these two, please don't get confused. It's just a very specific quirk of the Tax Act that it always uses property. So in the Income Tax Act, property is defined to include both tangible, things you can hold, touch, feel, carry, and intangible property, property that's more conceptual. An example of this is goodwill or brand purchases. This the intangible functions in business that relates to having a logo, a relationship with customers, etc. So this is plus capital expenditures that do not necessarily result in the acquisition of property. So the two categories of capital property are depreciable and non-depreciable assets. Now, non-depreciable assets usually refers to vacant land or shares of a corporation. These are items that simply exist. If we bought a piece of land, we might dig a bunch of holes in it, we could put a building on it, we could do a lot of things. But even if all that stuff got washed away, the piece of land is still there. So land's not really considered to depreciate. Shares of corporations, even though the value of a share goes up and down, that share is really a right to financial distributions. So even if the share becomes worthless, the right didn't go anywhere. So shares aren't considered non-depreciable. Depreciable property, depreciable assets, usually refers to any asset we might purchase that will slowly get used or worn down. If I buy a machine that prints t-shirts, that machine can only print so many t-shirts, so many t-shirt logos before it's going to wear down and stop working, at which point I'll have to put into some money into it to get it back in working order, or I might get a new improved machine to replace it. So depreciable assets are commonly worn down. You can have depreciable and non-depreciable assets connected. This is most commonly seen when you buy a building. Whenever you buy a building, if you own it, you are also kind of buying the land the building is on. So whenever we have a building purchase, we will associate a portion of that purchase price to the underlying land. So the building will age, it will break down, it will get used, it will depreciate. So it is a depreciable property, but the land portion will continue to be land forever. It's non-depreciable. So that's the key thing to be aware of when we're discussing these properties. CCA, the capital cost allowance, only applies to depreciable properties. The Income Tax Act Section 18 prohibits deduction of capital costs. So it says, hey, I bought a machine for $50,000. You can't expense that right away. Income Tax Act 20 allows deduction as permitted by regulation, such as part of the capital cost. So we're not, if we buy a piece of equipment, a piece of property, we're not allowed to deduct it from our income. But we are allowed to deduct part of it from our income. And this is the capital cost allowance. They use the term allowance because it's how much of that cost that we are allowed to expense in a given year. So, as well as land, the following are also not included as depreciable property. Capital expenditures allowed to be deducted in full. From an accounting standpoint, if we have some particular landscaping costs, we might capitalize them. But from a tax perspective, landscaping specifically is outlined as a type of purchase that you would expense fully. Even if you consider that it might be a depreciable property, we're just going to expense it. Inventory is also something that's not depreciable property. I mentioned before about a machine that prints logos on t-shirts. So if I buy the machine and use it to print t-shirts, that is a property. It's an asset. I'm using it in the pursuit of my business. But I bought that machine from another business, and that business might sell printing machines, in which case they're not using the machine to produce an asset or to produce shirts for another business. Their business is buying and selling machines. So this machine isn't a capital asset, it's inventory. Inventory is not reduced because inventory is not used the same way. That machine's not getting used to print t-shirts, except maybe in a demonstration. It's simply there to be resold. Any property not acquired for purpose of earning income, this is especially true of anything you buy personally. If it's not used to produce income, let's say I bought a TV. I bought a TV, I'm using it myself. Even though that TV is only going to be good for a couple years, I can't depreciate the TV because it's not associated with any income that I'm earning. But if I have, say, a restaurant or a bar, and on the walls I have a handful of TVs so that people can watch or have something playing in the background while they have their meal, now that TV's associated with my income earning process. Now it might be able to be depreciated. So things used for personal use cannot be depreciated. Things used as part of an income earning process can be. We already discussed land. Shares of corporation are generally considered non-depreciable capital property. And then we get into animals, trees, shrubs, herbs, or similar growing things. Biological assets are dealt with differently than machineries and equipment. If I have a dog, let's say I buy a puppy, is that puppy depreciating when I get it? No. That puppy has to grow. It's going to grow into an adult. Okay, so for the first couple years, I'm getting more dog out of it. Now that it's fully aged, can I depreciate it? Commonly not. Or just no. Do biological items, that's not even the right way to say it, biological entities do not depreciate in the same way that a machine would, where it wears and tears. If I have a dog who, golly, well, let's say I have, Let's say I have a tour business and I have a carriage that's pulled by a horse. So I have a horse that pulls the carriage. Now, although that horse will get old and perhaps pass away, I will deal with that when the horse passes away. As long as the horse is alive and is healthy, it is performing that function of pulling the carriage, um, exactly as it did last year and exactly as it did the year before. So animals are not depreciated. Trees and shrubs, items that we plant and will grow over time, also are non-depreciated. So let's go to the exercise for this. We're going to go through a short list of items and discuss whether or not they are depreciable property. Identify whether the expenditure is on account of income, a deductible current expense, or is a non-excluded capital expenditure. If the expenditure is a capital expenditure, determine whether it is depreciable property. So is it capital? Is it depreciable? A pet store acquires 6 puppies to sell. Is this a capital expenditure? No, because it's a pet store, those puppies represent inventory. They were uh, puppies acquired for the purpose of reselling at a profit. A warehouse facility purchases 2 guard dogs. So this is a similar transaction. We've purchased dogs. In the first example, those dogs were inventory. In the second example, this may be a capital expenditure, but because they're animals, it is not a depreciable property. So we won't take CCA on these dogs. 100 shares of a public corporation were purchased for $5,000. Corporate shares are non-depreciable items. Although this could be considered a capital expenditure, we are going to hold on to those shares while their value goes up and down, and we will sell them at some point in the future. But the share itself, the right that it gives us to perhaps vote for the board or have a right to dividends, won't be affected by time. So they do not depreciate. An existing business is purchased, including an additional amount for goodwill. From an accounting perspective, we often don't amortize goodwill. We don't depreciate it over time. It simply sits on the books. Now, this is not treated the same from the perspective of tax. If you have goodwill, it is considered a depreciable expenditure and it depreciates at about 5% per year. So that is our first yes. This is a capital expenditure that is depreciable. A cottage is purchased that is rented out on a monthly basis. This cottage is in the action of producing income. It's being rented out. So, because it is a piece of property that's used for income and a building is depreciable, this is also a yes. We can take CCA on this item. All of the plumbing of the cottage is replaced at a cost of $15,000 while it is still being rented. Now, we didn't spend $15,000 to buy a new cottage. We're making a renovation of an existing cottage. What the general idea is, if we have an expenditure that simply maintains a property, that is a current expenditure, a current expense. It's, just maintenance, repairs and maintenance. If we add something to a property that is expected to either extend its lifespan or improve its outcome, its productivity, then we can include it in the cost. We can add the cost to it. Um, for example, let's say I bought that machine that prints logos on t-shirts. I have the machine, but I need to pay additional money to make it functional. So I have to install it and have to have it delivered to my facility, installed on the floor. Perhaps certain gears and gauges have to be monitored in order to get it ready or calibrated. The cost associated with doing that can be added to the cost of the machine itself. Now, let's say the machine originally only prints black and white. And after a couple years, I say, you know what? I can add a modification to it that will allow it to print in color. So that expenditure, that additional amount I'm paying, is improving the asset. So all of the plumbing in the cottage is replaced is probably something we're doing that can extend the life of the cottage. By replacing the plumbing, the water line's going to be better. Maybe we have less water damage. We're improving its lifespan. So that $15,000 can be added to capital cost. Since the cottage is a depreciable property, this amount's depreciable as well. At the beginning of 2025, the cottage is no longer rented and the owner begins to use it exclusively for personal use. If the cottage is no longer used in the process of earning income, it can no longer be depreciated. A franchise to operate a specialty coffee shop is purchased for $250,000. A franchise to open a coffee shop is a capital expenditure. Although the coffee shop, the building is physical, franchises are intangible, they're conceptual. When we talk about Tim Hortons in Canada, Tim Hortons is a recognized name. If I was driving down and I saw Tim Hortons, I immediately know what's available on the menu because I'm familiar with the company or that franchise. So that relationship, that marketing that's embedded in the franchise's name is an intangible asset, and these will be depreciated over the life of the franchise. So yes, capital expenditure, depreciable property. In the solutions, I've provided just kind of a short reminder list, so you don't have to go through the entire discussion to know what it is. 6 puppies, no, counts as inventory. We have our simple reasonings here. Okay, I just want to get a couple more slides through before we end this first video. CCA, capital cost allowance, is the tax version of amortization. Income tax operates based on legal concepts and principles, not accounting principles. So the accounting-based profit or loss is often converted to net income for tax purposes. Accounting has different depreciation concepts than the Tax Act does. Accounting is concerned about matching costs over the expected life of depreciable property. So we might say this machine's good for 8 years, we will amortize it for 8 years, or we might say this machine's good for 15,000 units. So if in the first year we produce 1,500 units, we'll take 10% of that full cost. The next year we only produce 700 units. Well, now we'll remove that amount from the total. We're trying to match the usage, the cost, with the expected life of the machine. The income tax provides targeted incentives to encourage business growth by allowing accelerated write-offs that ignore useful life. From a tax perspective, you have a piece of machinery, boom, we can take 20% off of it. We don't need to worry about calculating the useful life. We're going to get that set rate. The thing about income tax is most of the classes use what's called declining balance. So if I have $10,000, I decline 20%. 20% of 10,000 is 2. So my CCA is $2,000. I have 8,000 left. Next year, I won't take 2,000 again. I'm going to take 20% of the new balance, $8,000. So declining balance is also something customarily used in income tax. That's not as often used in business. A lot of small businesses will just gear their amortization calculations to whatever the CCA is going to be. So in that way, they are going to be the same. But accounting choices, if we're actually doing over useful life, is not usually based on declining balance. It's based on usage. So we have these comparable wording, these comparable terms. So in the income tax, we consider capital cost. This is the same as the acquisition cost from the perspective of accounting. The capital cost allowance is the amortization or depreciation expense. How much are we allowed to deduct is our amortization. The undepreciated capital cost, the amount of our cost still yet to be depreciated or still yet to have CCA on it, this is the equivalent of the carrying value or the book value for accounting. Just for reference, I've included these terms. So if while I'm speaking in these lectures, I might accidentally use accounting terms because I'm more used to it, Don't try not to get confused. There is the equivalent term. So capital cost, acquisition cost is always sort of referenced as the original cost of the asset or property. Here's the items included in capital cost, and we'll get into certain items excluded from capital cost. So accounting, cost of assets tracked individually to determine annual amortization, carrying value, and whether gain or loss when particular assets sold. At year end, the carrying value equals the acquisition cost less amortization. The income tax, an individual capital cost tracked to determine amount added to UCC for each class of undepreciable properties. CCA claimed in current year reduces UCC at the beginning of the following year. So in accounting, we kind of keep track of all of our assets and we calculate the amortization on each of them. From a CCA perspective, all assets go into the same bucket. So we say, okay, here's our bucket for vehicles. So we bought 2 trucks, we have a tractor, we got a forklift. All of that gets put into the bucket and all of their costs are added together. And that's the number that we will take CCA on. Whatever's left from that CCA, so we have our combined cost minus our CCA, whatever's left becomes the new beginning balance next year, and CCA will apply again at its given percentage. In accounting terms, ASPE considers the write-offs from acquisition costs to be amortization. IFRS uses depreciation for tangible business assets and amortization for intangible. Generally, they'll use straight line or a method based on usage. Income tax, CCA, is mostly declining balance. There's a few caveats to those. Some classes that don't use declining balance, they do use straight line, but we'll address those as we're going through the classes. One thing to note is our calculation for maximum CCA is just how much are we allowed. This is how much you can expense, but we don't have to take that full amount. There might be situations where we say, okay, our CCA calculation says we can take $4,000. We're only going to deduct $1,500 this year for whatever reasons we might have. So our total CCA is our maximum CCA is discretionary. And then we'll get into dispositions. So proceeds looks at what when they sell an asset from our accounting perspective, whatever I've received for that asset, my proceeds, we compare it to whatever our book value was, and whatever difference is a gain or loss. Income Tax Act is a little bit different. We look at the difference between the UCC and the lower of capital cost or proceeds. I will get into dispositions later, but the concern is how much we receive for an asset could be capital gain, which is taxed differently than a business expense such as CCA. So since these items are taxed at 2 different rates, there's consideration about when did those proceeds become capital gain, and when was it simply recovering CCA expense that we might have had in the past. We'll go into those details in the later videos. Okay, let's stop there because we're over 23 minutes. In the next video, I'll continue to talk about some of the basic CCA items, and then hopefully we will see a simple CCA calculation that we can start building our calculations off of. See you in the next video.